The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with myself and you. So let's have a lovely Monday morning. These are your headlines. Donald Trump's trade war hits the European Union, threatening a 30% tariff on exports to the United States from August 1st, but leaves the door open to a potential deal if the bloc makes more concessions.
We're dealing with other countries and certain countries that would rather have a deal than a regular tariff, and we're willing, if they're willing to open up. The European Union is talking to us. They want to open up their country.
The EU holding off from any immediate retaliation, but Commission President Ursula von der Leyen says the bloc is preparing countermeasures, such as targeting as much as 90 billion euros in US goods.
We will therefore also extend the suspension of our countermeasures till early August. And at the same time, we will continue to prepare further countermeasures, so we are fully prepared.
So we've got European equity futures falling, but looking to avoid a severe sell-off as investors hold on to hopes for a negotiated settlement. So what do you think, everybody? I'm actually pretty heartened by the reaction on markets at the moment. The market's not glib, I wouldn't say complacent, but just cautious about the worst case scenario for a lot of these tariff talks. Of course, we went into the weekend wondering about the letter from the EU, or from the US to the EU. Would it be 10%, which was going to be the base case scenario, or was it going to be higher? And it's gone in higher as well. But it's all kind of got a bit, Kenny Rogers, the gambler, hasn't it? Know when to hold, know when to fold. And it reminds me of a big conversation I had just a couple of months ago with a Trump 45 cabinet member who told me, and I was interviewing that person, who told me that you don't immediately react when Trump comes up with something big. You hold on, you wait 24 hours and you have a think about it, and then thereafter, if you don't go up too robustly, a deal is almost certainly to be done. And I think that is very much what Ursula von der Leyen and the Commission and Maros Sefcovic, the negotiator, are doing at the moment. They're just holding off. They're not reacting aggressively. And they're saying, right, OK, let's just see if we can get a deal done here as well. When you look at the US futures as well, it's the same kind of story. Now, the markets in the US were a little bit downbeat. The US futures, if I just get an early sneak peek of those, thank you very much indeed, Brittany and the team, down around about 0.5% in the implied open. So yes, coming off the top, but again, no massive knee-jerk reaction. The president has threatened to hit imports from the EU with a 30% tariff rate from August 1st, despite both sides having indicated, and this is the point, that progress actually had been made in recent talks. The US leader said the levies would be waived completely, if the EU or European companies decide to build or manufacture products within the United States. Can I just hold off again then from the reads? Because I have spoken to, I reckon, 100 European business leaders, let's say 100 plus, over the last year. Way more, a couple hundred, 300, I don't know, I don't keep a tally. And every single one of those ladies and gentlemen who run European, not British, European companies have said to me, because of IRA, remember IRA, everybody? Yeah, Inflation Reduction Act, that they felt that there were better capital allocation decisions to be made in the United States. And that's what they were doing. That's what they were doing anyway. So you were already seeing with previous US policy, let alone this US policy, and again, we don't have to be political about this. We can say, look, there's a concurrent trend here, regardless of the inhabitant of the White House, that European decisions were already being made to allocate capital there. All right. Now, the US leader argued he's seeking a fair trade approach with key American partners.
We're dealing with other countries and certain countries that would rather have a deal than a regular tariff, and we're willing, if they're willing to open up. These are countries that have been shut to us, but we've been open to them. In other words, they wouldn't let us do business there, but they would do business in our country. Not a fair deal. So the European Union is talking to us. They want to open up their country.
In his letter to the EU, President Trump said the 30% tariff rate would be separate from all sectoral tariffs the US is currently hitting the bloc with. Trump has already hit European steel and aluminium imports with a 50% levy, whilst autos are subject to a rate of 25%. European Commission President Ursula von der Leyen says the bloc will refrain from responding with reciprocal tariffs in a bid to give peace a chance. No, that's John Lennon. Give talks a chance, but insisted the bloc was prepared.
The United States have sent us a letter with measures that would come into effect unless there is a negotiated solution. So we will therefore also extend the suspension of our countermeasures till early August. And at the same time, we will continue to prepare further countermeasures so we are fully prepared.
Now, EU members have already approved a reciprocal tariff package on 21 billion euros worth of US goods. Do you remember seeing the list? It is absolutely enormous. All kinds of, meat products, offal, stuff I never even knew existed in the chicken world. Anyway, which has so far been suspended as trade talks continue. A second package of countermeasures is expected to be discussed at an EU trade ministers meeting today and will reportedly target around 72 billion euros worth of US goods. Now, CNBC understands that von der Leyen's wait and negotiate approach has the support of the 27 EU members, with one source describing President Trump's letter as part of an erratic and unpredictable strategy. European leaders have been quick to respond, with the German Chancellor Friedrich Merz warning tariffs would hit the country to the core. The Italian Prime Minister Giorgia Meloni said a trade war within the West would weaken us all. French President Emmanuel Macron expressed his strong disapproval, whilst the Irish Taoiseach Micheál Martin said that whilst all options remain on the table, the EU would prefer to strike a deal with Washington, D.C. Again, I'll just show you those US markets again, just very brief. This is actually where we performed at the tail end of last week. And it was one of those interesting weeks where the back and forth, the swingometer between European market performance and US equity performance swung in favour of the Europeans. So, for instance, the DAX was up 2% last week. The S&P 500 over the week was down 0.3%. The Asian indices are looking like this as we speak. Again, very tempered reaction to the latest tariff letter from Donald Trump. European futures, last time I looked, they were down, but nothing dramatic. I mean, look, the FTSE, which has got its deal, apparently, looking smug, Mr. Starmer, about one thing at least, anyway, down 0.1%. That aside, we do have 0.9 to 1% average declines across the board. Let's have a look at the US futures again. I think they were down 0.5% when we looked at the top of the show, and that is roughly where they are. Now, I happened to go to a sporting event in which the whole of the London EC, the whole of the city was there, apart from you, Christopher, at the tail end of last week. And funnily enough, you'll like this story. I'll just do a quick anecdote. How are you?
Oh, very good, thank
you. I'll give you a quick anecdote. I know you're a massive cricket fan, and obviously there's a very big game going on at the moment between 1.4 billion Indians and Britain.
That's We're holding our own, just about.
But it was quite funny because there were two very nice gentlemen who are city traders, and they said to me, we have a bet in the office every time you say the word ergo.
Oh, right.
Apparently I say it a lot. Not you, me.
That's a great word, yeah.
I use it all the time.
Ergo.
And they're cheering in their office now this morning. So I've now got to think of other words.
Right.
Consequently, therefore,
yes.
On the back of the,
as a result,
other conjunctions as a result,
such that off we go.
Off we go. So Trump's tariffs.
Yeah.
Consequently, trying hard. Consequently, no major European reaction, no major market reaction yet. Do you think that's the right way that the market is thinking about this?
Well, what a great question. I think the market's is starting to run out a bit of steam, isn't it? And I think you can see that last week with the US markets, as you talked about. They're sort of starting to struggle after really being very strong since the April 7th, April 8th lows. So I think the market's digesting it. We kind of all know that this is part of Trump's negotiating style, isn't it? It's the art of the deal, throw everything at the wall, see what sticks, be aggressive. And you can see with the EU reaction, they know that. As that last quote said, unpredictable strategy. So I think the market's contemplating. It's clearly not good. I mean, we don't know where we're going to end up, but it's not a great direction of travel.
So I'm holding off on some really obvious questions to you about the market, because we've got a whole market segment talking to you in a short while about a lot of not flashing, but flashing red stroke amber indicators that you want to bring up as well. But in terms of, you just said it's clearly not good. Yes, on the surface, for the world economy, for world trade flows, for investment decisions, and thereafter, consequently, for markets. I'm trying so hard. I've now realised how many times I say the word that won't be mentioned again. It does seem clearly not good. And yet, is there a scenario where this galvanises investment? It galvanises investment decisions. It makes people think long and hard about the regulations and permitting and big rule book we have in Europe, but actually acts as a catalyst for real positive change.
Well, I think that's happening. I think Trump in general has been a catalyst, particularly
like NATO,
in Europe. Yeah, NATO is a great example. The German defence spending, the German infrastructure plan, the chat about deregulating banks amongst some of the central bank governors in Europe. All this kind of stuff is a catalyst, there's no doubt about it. And Europe's really had sort of 15 years post-GFC, post-Euro crisis of sort of being risk-averse, if you like. And you've seen it in the regulation, tightening up on this and that, whether it's bank capital, looking after the consumer and so on. And now I think there's a shift the other way that we've seen in the last 6-9 months. And Trump is definitely part of that. But having said that, adding tariffs to the global trading system is not a positive. No. The economists don't agree on much. But free trade is definitely a good thing. Comparative advantage a good thing. Now, I accept that if there's unfair trade practices and stealing of intellectual property, that's a bad thing, and the WTO has no teeth, sure. But undoubtedly, adding tariffs to the global trading system is not a positive.
But there is a case to be answered for unfettered free trade being detrimental if the balances between one country and another get out of kilter as well. Again, I've had this conversation with one or two academics who say, yeah, free trade is great and it works really well until the balance is so far that actually one nation is consuming so much and other nations are producing so much that actually there is a lack of balance here as well. And we have got that in the Trans-Pacific relationship, haven't we? It has gone too far, hasn't it?
Well, there is something to be said for that. That's true. And part of that Trans-Pacific side, the China side, is unfair trade practices and dumping. And there are different approaches to economics in China versus the US. China is very much about driving supply. China is just, if you build it, they will come. And America, of course, is what's the market signal? How much does the market need to absorb? So those contrary systems do create those imbalances. Having said that, I think this is far more complex than people think. The idea that the trade deficit is a scorecard is not entirely correct. De Gaulle talked about the American exorbitant privilege. Actually, it wasn't de Gaulle, it was his finance minister, but everyone thinks it was de Gaulle. But the point is, if you look at... so let me put it to you this way. Yes, there's a trade deficit America has with the rest of the world. And as a result, the rest of the world owns a lot more assets in America than America owns in the rest of the world. But the income off those two different asset streams is actually the same. So even though the rest of the world owns, I think, about 35% more assets than America does in the rest of the world, if you follow my drift, the income generated off those two is equal. So actually, even though and that's because you run a deficit, you end up with that asset imbalance. So it's more complex than it seems on the surface.
It is on the digital and the services side as well, the dominance the US has in those areas.
Yeah.
Chris, I'm just told by wonderful producer Brittany that we're going to do one massive chat now. So what I really want to do is segue, without using the other word, consequently to the market reaction. And I want to know about your caution, because I think you have various parameters available in your toolkit, and all 6 of them, or at least 6, are telling you get out this market, or at least don't buy more. What's it saying?
There are 6 reasons that we're worried about summer turbulence.
Yeah.
So this isn't...
You haven't got any notes. You've got to remember them all as well.
I'm sure you'll interrupt me by the time I get to the 2nd or 3rd, so I don't need to remember the 6th.
How dare you?
No, it's fine. I mean, you can group them into 3 categories, which are basically what I call fundamental reasons, technical reasons, and the dollar, basically. So the fundamental is the US economy slowing. I mean, it's clearly slowing. There's no two ways about it, in my opinion. We've been running this theme in the US. There's what I call a soft underbelly of growth. And a lot of the US economy is struggling. Housing's a great example, but there's been no industrial cycle in the US for 3 years. Industrial production is flat as a pancake for 3 years. So there's a lot of bits that are feeling that tight money. Interest rates are too high, yields are too high. You can't get housing going with 10 and 30-year yields up where they are, or not going seriously. So there's that issue, and then we've got, actually, believe it or not, I know we've been talking about the one big beautiful bill for a while, but fiscal policy at the moment is been tightening up for 6 months. And you can see it if you look at government spending. You can see it if you look at a cumulative daily deficit. It's quite hard to measure that, but et cetera, et cetera. So fiscal's been driving the US under Biden for 4 years. It's now tighter. It'll get looser next year. Monetary's tighter. So the economy's slowing. Real income's slowing. Job creation, I think, is slowing. So that's number one. This is going to take a while.
No,
I hope it's a long segue.
You've preempted by keeping me mute now by telling you I'm going to interrupt. So
I feel bad.
No, don't feel bad. I'm desperately trying not to interrupt because you've said so many interesting things, including rates too high, which I think is an interesting scenario. Okay, come on, let's whiz through a couple more.
Well, number two is tariffs is disruptive. So, and there are other things that are slightly disruptive on that sort of side. And then 3, 4, and 5 are sort of technical model factors and the way the market's trading, if you look at defensives versus growth. You know, our defensive part of the global stock market, or the US stock market, is giving a signal, because it's underperformed dramatically, that actually markets need a pause or even a give-back phase.
Yeah.
And of course, markets always struggle over the summer anyway. That's pretty much the normal playbook. You know, May to October versus October to May, where all the gains are made. So you've got all that. You've got our models, our sell-off indicator, that sort of stuff.
People love the technical stuff, so just give me a bit more. So you've done the defensive signals have underperformed, telling you to pause or it could give back. The seasonals are against. Any more of the technicals?
And then the models basically is the technical stuff. And then the last thing is the dollar. I mean, the dollar is such a consensus short now. It looks to me like it's due a counter-trend move, a bit of a rally. And of course, normally when the dollar rallies, equities struggle.
And when you say counter-trend move, you mean that's a short-term tactical move rather than a longer-term thematic move?
Exactly.
Yeah, so longer-term thematic, you still think the dollar has weakness?
I think the long-term trade in the dollar is now down. The pattern of global growth is very different from the last few years. A whole topic we could get into, but we call it return to the noughties.
Yes, very good. In terms of what this pullback looks like, the quantity and the timing of it, do you have any thoughts on that as well? Because our viewers who probably agree, again, it's what is it? That old adage that came up last week, but it's been going around for millennia. Is the bulls? No, the bears make sense, but the bulls make money. So
the bears make news. The bears make news. The bulls make money.
Yeah, that wasn't the version I heard. But anyway,
you're right. It's not right. Sorry. What is it? The bears sell newspapers. The bulls make money. That's what it is.
Sounds good to me. In terms of the elongation of the downtick, what do you think?
I'd call it a 5% on the S&P, top to bottom.
Okay,
maybe it gets to 10, but it's something.
17%,
Yeah, this is not a giant pullback. I mean, it's very interesting. If you look around the market, there's a bunch of you can break the market into different groups. Yeah. Retail's been involved.
Retail did well.
Retail done well. Investment advisors have done well. If you look at the US investment advisory group.
Hedge funds did badly.
Hedge funds are not in it. And
Shame.
A lot of institutions, I think, want to buy the dip. So I don't think it's a retest. That's a big debate, but I don't think it's a retest of the April lows.
Lovely.
How about that?
Yeah, that's great.
Thank you.
I thoroughly enjoyed it.
Are we done?
No, actually, I've got no one else, so you can save it up. No, I'm joking. We've got to get rid of you, apparently. You're making me look bad. No, I make myself look bad. Lovely to see you.
Lovely to see you. Thank you. Enjoy the cricket if you make it.
I think I've got to go and do my job instead.
Yes.
Chris Watling, CEO and Chief Market Strategist at Longview Economics. Thank you, sir. Thank you for your time. Just to say, our US colleagues later today will speak to Kevin Hassett, Defender-in-Chief of US administration policy. He's the National Economic Council Director. That is an amazing interview, and that's going to come up at 10 minutes past 1 London time. China exports, meanwhile, grew more than expected in June, coming in at 5.3% higher on the year in dollar terms versus the 5% expected. The country's customs office said trade with the United States has shown signs of recovery. Well, that's fascinating. We're going to get out to Elaine now, who joins us with plenty more on this. Elaine, lovely to see you.
Great to see you, Steve. So some surprises to the upside for sure, with exports in June growing 5.8%. That's beating estimates of 5% and much higher than the 4.8% in the previous month. And now that the June data is out, if we look at the data for the first half of the year, exports to Europe grew 6.6% and exports to the U.S. were down 10.9% in the same period. And the June data does show that shipments to Europe and ASEAN countries have largely held up, which helps offset the fall in exports to the U.S. Although I should note too that the fall in June was not as steep as the fall in May, and that's largely because of the Geneva trade truce that saw U.S. tariffs on China being brought down from as high as 145% to around 55% in May. But experts say another reason for China to post a trade goods surplus of $115 billion in June is because of strong exports to Europe. And if we look at the latest data, China exported more to the EU in the first half of the year compared to the US. And that just shows how important Europe is as a market to China. And now the big question, of course, is how sustainable this strength is. And the focus, of course, will be on the China-EU summit in late July. And China and the EU have imposed tit-for-tat restrictions and tariffs on a number of goods, from European brandy to Chinese EVs to medical devices now. But a lot of China's economic picture on exports also will hinge on Trump, not just the deal he will negotiate with China, but also the tariffs that he has imposed on other countries that targets transshipments of Chinese goods via other countries. So for sure, there's a lot of uncertainties ahead, Steve.
Indeed there is, Elaine, but thank you very much indeed for talking us through. What have we got? Have we got more clarity or less clarity? I don't know, but thank you for talking us through the story nonetheless. Okay, coming up on the show, we're going to dig into the outlook for the earnings season in Europe and what it could tell us about the UK's stock market. All the details after this break. Plus, we'll ask what's next for crypto. As Bitcoin, what is it currently trading? It's 122,000 and a bit of change at the moment, crossing $120,000 mark for the first time. And we're going to digest the latest developments in EU-US trade with Bag Volkman, who is policy analyst at the European Policy Centre. Don't miss that conversation, coming up at 9 London time. Right, welcome back. This week sees the first major reports of the second quarter earnings season. Now, stateside attention will be on major lenders, including JP Morgan, Goldman Sachs and Citi, whilst in Europe we'll get results from companies such as ASML and Novartis. Global earnings expectations have fallen sharply in the wake of President Trump's tariff announcements, and forecasts for Europe have been particularly hard hit. On April 1st, analysts expected 7.2% growth across the Stock 600, but now see a narrow decline according to LSEG data. Strength in the euro, as well as falling expectations in consumer-facing and energy companies, are expected to hit many firms across the continent. Earnings season will pose a key test for companies in the UK, of course, after the country's FTSE 100 scaled fresh record highs. Analysts will be tracking the impact of falling energy prices, as well as any commentary on the effects of tariffs and the health of the UK consumer. Well, Ritika has been looking at the performance of the FTSE and ramifications thereof. Good morning to you. Talk us through how the FTSE's been doing.
Good morning. Well, Steve, it's been a great year so far for UK equities. FTSE 100 hitting fresh record highs, up year to date about 8%, even outpacing the S&P 500.
Plus your invested dividend.
Exactly. So dividends are a great benefit that we really do enjoy here in Europe. But sticking on to that point of the comparison with the S&P 500, up some 6.5%. And we've really seen that rotation, from the tech with those lofty, high valuations. Investors are looking for bargains, so they've turned their attention to some of those value plays, energy, banks, and that's really boosted the UK market.
In terms of the headwinds ahead, obviously we're concerned about what's going to happen in the, not long away UK budget now as well. The weekend press is always full of it as well. What are the other key factors to look at?
Of course, as you mentioned, some of the key headwinds, tariffs. We've actually seen a lot of companies shaking off the concerns about the tariff. The FTSE 100 is made up of a lot of multinational companies, and so far we've seen that taco trade really come into play there. UK companies specifically, though, they're going to be looking at the health of the consumer. We talked about that GDP data last week deteriorating in May. We've had some weak retail sales. So that's also going to be a focus as well.
So let me get this right. UK government sees weakening growth partly on the back of their policies where they increased taxes a year ago or in the last budget, and their answer is to raise taxes again on the people who would be spending, yeah? Is that going to be the answer?
So I think that's what's going to be difficult for consumers. On the one hand, as you mentioned, with higher tax, we've also got higher inflation. That's still well above target, how that's going to weigh in and impact some of these companies when they report earnings. But also for employers, we've seen the national employers insurance tax rise. We've also got a rise in the national minimum wage. So that's going to increase the cost base for employers. So that could start to eat into profit margins.